Hello there, and welcome to the second of two videos being produced to accompany our latest quarterly report. In the first video, we looked at what's been happening in the economy and markets, and we observed that actually 2025 was a pretty good year for lots of the different asset classes. In this video, we'll look at how that's translated into portfolio returns, what's been driving those returns. And as usual, we're going to focus on the core portfolios, our cautious, balanced and adventurous portfolios. But in the written report, we've got all the other portfolios and lots more detail, so please do have a read of that if you get the chance. Now, of course, we always say investing is for the long term, so as usual, we're going to start by looking at what long-term returns have been like. So this table shows the returns of our core portfolios over the last 10 years. As you can see, all the portfolios are up quite a lot. Cautious is up 52% over that period, Balanced 62% and Adventurous up 83% over 10 years. So that works out as 4.3%, 5% and 6.2% per annum in essence on average over the 10-year period. As usual, there are two main benchmarks we use for comparison. Firstly, there's the typical mixed investment fund, which has between 20 and 60% in the stock market, and they've produced around 57% over that time frame. So that's slightly more than our cautious strategy, but less than our balanced and adventurous portfolios. So our cautious strategy, as a reminder, tends to sit towards the lower end of that 20 to 60% equity range. So we'd expect it to lag when stock markets are going up strongly, as we've seen recently, but it should also fall less when stocks fall. Whereas our adventurous portfolio is basically designed to do the opposite, and that's why that has done particularly well recently. We also compare the portfolios to the typical wealth managers' mixed investment portfolios. So these are up about 53% over the same time frame. So in general, we're pretty pleased with how we've performed against the competition, if you like. But the important thing is how much the portfolios have grown in real terms. So our objective when managing these portfolios is trying to get those real returns over and above inflation over the long term. And as you know, that's been quite challenging recently when we've had very, very high inflation in the past couple of years. Over 10 years, inflation averages about 3.3% per annum. So that means that despite that high inflation, all the portfolios have grown in real terms over the decade. We're also comparing on here to typical cash returns, where an account paying base rate would have given you about 1.7% per annum on average over that time frame. And that, of course, is below inflation. So again, as usual, we're showing this because we think it's important to demonstrate actually it is important to invest your money if you want to see it grow over and above inflation over the long term. And where possible, we want our core portfolios to achieve those returns without taking any undue risk, with really the lowest risk we think is realistic in order to achieve those kind of returns. So more recently, what that means is in those portfolios, we've tended to put more in fixed interest, in bonds, because in recent times we felt the yields were attractive, and that meant we could see some pretty good returns relative to the amount of risk taken. And we've had a bit less in stock markets where, again, we thought the returns looked okay, but we would have to take a lot more risk to do so. So this table is similar to the previous one, but this time we're just looking at 2025 returns. So in 2025, cautious returned over 8%. Balance was essentially 9% and adventurous was well over 10%. So that's what I mean when I say it's been a really good year in absolute terms. Now those numbers are really pleasing, particularly when we adjust them for risk, because our cautious and balanced portfolio have produced returns which has actually been slightly behind the average balance fund over the year. But if we adjust that for risk, then they've outperformed. So essentially they have been less volatile than the sector, and so for each unit of risk they've produced a higher return. So on a risk adjusted basis they've done really well. So this next chart sort of illustrates our approach. As I said, for some time we've been saying we really liked fixed interest, particularly those higher yield corporate bonds. That's where we're lending money to slightly higher risk companies, but in return we get paid a higher level of interest or higher yield. And we felt over the last couple of years that that asset class was really quite attractive. And it's not without risk, as I say, but generally it's considered less risky than equities, and we felt the sort of potential returns were roughly similar. So this chart shows our high yield funds in green compared to the S&P 500 in red. And what we can see is that over the last 12 months, the high yield funds produced nearly a 10% return. Meanwhile, the S&P 500 returned about 9%. But more importantly, we can see the green line was very, very steady, whilst the red line has been much more volatile. So at one point, the US market was down about 20%, for example. And that illustrates the point that we've been making over the last year or two, that we felt we could achieve equity-like returns from high yield, but without the equity-like risk. Now, we're just using that to illustrate the point. Some other stock markets did better than the S&P 500, as we've seen. Notably, here in the UK, the FTSE 100 returned basically 25% over the year. So again, that's positive for portfolios, particularly for the UK equities. We tend to have a little bit more UK equities than some other asset managers out there. And it's also very positive for the defined returns that we hold in portfolios. So for those of you that aren't particularly familiar with defined returns, very briefly, they are structured products which are based on an index like the FTSE 100 or the S&P 500. And they will give us a predetermined return. The return we're going to get is fixed at outset, and that will be paid should the markets that we're based on be at the same or higher than they were at the beginning at any one of a sort of designated kick-out date. So generally those kick-out dates are either every anniversary, every 12 months after the product was set up, or every 6 months, up to a maximum of 5 years, or in some cases 6 years. So those products are sort of things we tend to really like in the portfolio, and they've done really, really well, as can be illustrated in this chart. So typically that predetermined return is somewhere between 10 and 12%. So to achieve that, we only actually need markets to go sideways, not to go up. But there are pros and cons of this approach. So defined returns is shown in black, and they produced over 12% in the last year. Again, that's what I'm saying, it's in line with expectations, exactly what we wanted them to do, really nice, attractive return. On this chart, we're comparing them to both the S&P 500 in red and the FTSE 100 in blue. Now, compared to the S&P 500, the products have outperformed, and again you can see they've done so with less volatility, so that black line is straighter than the red line. However, we would have seen better returns if we'd have put the money directly into a FTSE tracker. You see the FTSE 100 has done much, much better. So the product gave an attractive return. It did so with a lot less uncertainty than holding direct equities. But of course, if the gain is fixed in advance, that means if markets go up strongly, they can underperform. So on the one hand, it's done exactly what we wanted to see. We've seen some very strong risk-adjusted returns. On the other hand, for the more adventurous portfolios, it's actually been one of our bigger detractors in terms of relative performance. So if we'd have put more money directly in the stock market instead and less in defined returns, we would have seen a higher return. But on a risk-adjusted basis, they've done extremely well, and actually we're very, very pleased with that result. So we continue to believe that this approach is the right one in the current market conditions. We know there's loads of risks out there, lots of things we won't be able to predict, particularly with regard to geopolitics. We know that lots of the markets look relatively expensive. So we just think doing things like defined returns or the higher yielding corporate bonds at the expense of so much equities, if we do things like get lots of diversification in the portfolios, lots of different regions, lots of different asset classes, again, we think that makes sense given all those risks and given that some of those markets do look quite expensive. And we think that, despite some of those risks, we still would expect, therefore, portfolios to do reasonably well going forward from here as well. So we hope we found that useful. As usual, there's plenty more detail in the written version of the quarterly report. And if you have any questions, please don't hesitate to get in touch. But we'll see you again next time. Thank you very much.